Hello and welcome to today's webinar, Bank Failures and Their Economic Impact. I'm Rob Dietl. I'm a Director of Executive Programs here at the MIT Sloan School of Management, and delighted to have you joining us for today's webinar. We know there's a large audience connecting from around the world, so really delighted to see the interest in the topic of today's webinar. And equally delighted to have one of our leading faculty on this topic joining us for the hour today to share his thoughts and insights on bank failures and their economic impact. We'll spend a bit of time focusing on Silicon Valley Bank and other banks and a variety of the factors and influences that took place last month and even leading up to that, and in fact are continuing today. As a note, as I introduced Professor Roberto Rigobon, I actually go way back, probably further than he remembers. I actually took his program, The Dynamics of Globalization, many years ago, about 12 years ago, well before I joined MIT Sloan, when I was working at the British consulate here in Boston as a commercial officer. And just spending 2 days with him that many years ago in the classroom really helped me in the role that I was doing, understanding kind of the many forces and factors that were shaping global economics at the time. And I continue to put much of that knowledge that I gained way back then to use today. And now in my capacity working at Sloan, I'm delighted to have worked with Roberto in the classroom. He teaches in many of our executive education programs. He leads a few of them, and we really reach out to him often as one of our top resources in terms of all things economics. Roberto is the Society of Sloan Fellows Professor of Management and a Professor of Applied Economics here at MIT. He's also a research associate at the National Bureau of Economic Research and a member of the Census Bureau's Scientific Advisory Committee. He's a Venezuelan economist whose areas of research are international economics, monetary economics, and development economics. He also does quite a bit of work in the area of financial contagion. He currently studies the properties of international pricing practices, trying to produce alternative measures of inflation, another important topic today, and is one of two of the founding members of the Billion Prices Project and co-founder of Price Stats. In addition, he's received numerous awards for his teaching and his research. Notably, he won the 2022 Teacher of the Year Award here at Sloan. So from our students here at Sloan to the participants that join us in our executive education programs, he always really conveys great frameworks and information in the scope of his teaching. So with that, Roberto, welcome and thank you so much for taking time out of your busy schedule today. Silicon Valley Bank really hit the headlines last March, about a month ago. And I remember walking by their branch here in Kendall Square and noticing that things were unusually quiet one day. And then I went home that night and read the headlines, and things kind of accelerated from there. And I think it was kind of a firsthand experience for me to see what was happening in real time with Silicon Valley Bank. Can you kind of catch us up on what transpired in March and kind of what's evolved over the past month to bring us up to date to where we are today?
Yes, perfect. Thank you so much for the invitation of being here. I see that in these 12 years, you look identical. You have not lost not a single hair. Look at me. I actually lost all mine. Let's talk about what is happening in the United States. And something that I want to clarify is that banks in general is an activity that is very vulnerable. And it has always been. We have many financial crises in the world. It just happens to be that in every country you get one every 50 years, so on. So for the people that live in one single country, it's hard to see more than one in a generation. So it actually, you see, one, maybe two. But when you actually look at the whole world, since the end of the 19th century to today, we have more than 125 financial crises worldwide. So this is something that happens a lot, and almost always is about a mismatch. There's always three ingredients that you need. Three. And this is true in every financial crisis, and it is the same case for Silicon Valley. So you need first certain degree of incompetence in the management. Somebody was not doing their job correctly. Then second, you need a mistake in the regulation. So somebody was not doing their job on the regulatory part. And then third, you need a trigger. And that trigger is what leads the weakness to appear. So Let me explain a little bit what happened in Silicon Valley. This bank grew amazingly fast. During the COVID years, the money that went to high tech sector and the biotech sector was expanding incredibly fast, so fast that they increased their deposits by 300%. This is very unusual. Just to give you an idea, deposits grow by 5 or 6%, and that's growing very fast. They were growing at 300% in those 3 years. So they grew incredibly fast. And they couldn't actually use the money for what a bank usually does, use the money, which is to provide loans. So what they did was to buy assets. And they bought treasury bonds, they got mortgage and backed securities. That is something that banks should not do. And banks do that in a very limited amount. Typically, when a bank cannot provide proper loans, a responsible bank, what they do is they don't accept the deposits. It's very simple. If you cannot use the money properly, you just don't get the deposits. But it was so hard for them to say no to money that was cheap. And then they invested that in assets. And what happened is that these assets fluctuate their value. And that means that, you put yourself in thin ice. And therefore, you're walking on thin ice in a lake. The regulator has a mistake. I will explain that mistake in a second. It's about a threshold that was changed in 2018 by the Congress of the United States. That was a massive mistake where they decided to put a more lenient regulation on what they call small banks. And a small bank is $250 billion. I mean, I have no idea who will ever call a small bank $250 billion. But anyway, they decided that 250 was small enough. I understand that that's small enough when you compare that to JP Morgan, but give me a break. This is the 16th largest bank in the United States, 16. So it's top 20. So, I mean, it should be regulated properly. So that was the mistake of the regulation. So the regulator, even though they knew it was on thin ice, they did nothing. It was kind of said, well, we according to the regulation, I should do nothing and let it go through. And then the trigger is what breaks the ice, and then you drown. And in the case of Silicon Valley was when the inflation rate in the United States became incredibly stubborn, which still is today. We can talk about inflation rate in a second, but inflation rate is not coming down fast enough, which is forcing the Fed to increase interest rates very fast. And that's the trigger. That lowered the price of the treasuries, that lowered the price of mortgage-backed securities. There was a hole in the balance sheet in Silicon Valley, and then they went bankrupt. Now, there are many banks that are in the exact same position. The difference between Silicon Valley and other banks is that Silicon Valley Bank just grew much faster than others. So that and Signature were the first two to go bankrupt. But there's a weakness in the banking system, and it's because they are all sharing the same thing. Very fast increase in deposits. They were misused. They were put aside as an asset. And then you have a common trigger and a common regulation that is not paying attention. So that's kind of what happens. Typically, when we move from here, typically what we do is that the regulator starts changing. So we modify, and I think that that's what is going to happen in the United States. I hope that they change the threshold. The threshold used to be $50 billion. So let me explain a little bit about the regulation of the banking system. Regulating a bank is really difficult, really difficult. You require a huge amount of information, and it's very costly for the bank as well. But why we have very costly regulations? Because we want to know if they're going to go bankrupt. The deposits have a guarantee from the government. And that guarantee comes from us citizens, through the central bank, through the Treasury, and through the FDIC. We have created institutions that provide a guarantee to the depositors that they're not going to lose their money. So we need to regulate so the bank doesn't lose the money, because otherwise we're going to be bailing out all the depositors all the time, you see? And we might be stupid, but we're not that stupid all the time. So we might make a mistake once, but not all the time. So because the deposits have this implicit guarantee, and it's implicit and explicit. Some of them are explicit, like, for example, almost everyone here in the call might know that for us individuals, when you open an individual account, you have $250,000 that protect your deposits. However, in macroeconomic events, the guarantees are expanded. For example, the reason why this is 250 is because during the 2008 crisis, the Obama administration increased from 100 to 200 and then from 200 to 250. So you see, there's an implicit guarantee. So there's an explicit one that said, for sure you will get 100, but don't worry, if something really, really bad happens, we will actually give you a bigger guarantee. That guarantee implies that we need a regulatory framework on the other side to make sure that the banks behave properly. But because this is costly both for the regulator and the bank, we usually have a threshold. And we said, well, small banks are small, and therefore, if they go bankrupt, we can take the assets and buy and sell them. Is that okay? We can restructure the bank. So the losses are going to be minimal. They are small, so therefore the implicit support or guarantee is relatively small, and we just can move, happily, and let the banks that are small to be regulated in a more lenient way. That's kind of the idea. And almost all the countries have a regulation where treat small banks differently than big banks. The banking system in the United States is about $30 trillion in size. So Congress said, well, 250 billion is 1% of that, so it should be small. But that's a mistake. It's $30 trillion because you have massive amount of assets accumulated in a couple of banks, okay, in a handful of banks, 20 banks. At the end of the day, $250 billion is a very big number. And they increased that number from 50 to 250 in 2018. So that created a gap on banks that allow banks to grow very fast from 50 to 250 without the proper controls. So I think that the principle of the regulation is not incorrect. I just think that the threshold was too big. So, and I think that today we know that, and I think that I think FDIC next couple of weeks, if it's not next week, it's going to be in 2 weeks from now, is going to make a recommendation about the change in the regulation. And I'm pretty sure they're going to lower that threshold to 100, something like that. So it's a little bit more complicated to understand the regulatory mistake, but I just want to make sure that everybody understands that you need 3 ingredients. And you need someone that is not doing their job on the private bank side, someone that is not doing their job on the regulatory side, and then a trigger that moves everything together. Banks can be in a bad environment for a long period of time. You need that trigger to convince depositors to leave or to convince investors to leave.
Well, thank you for that, Roberto. I think that's very helpful context in understanding how and why things transpired the way they did. Shifting gears for just a moment, can you talk to us a little bit about the impact and maybe the aftershocks that the SVB collapse had? I know they had a reputation for being a critical part of the innovation economy and the entrepreneurial economy. It's an economy that thrives here in and around the MIT campus, but also in other parts of the country and in North America. And there seemed to be a scramble after the news broke for how many of these startups and entrepreneurial firms would secure funding, make their payroll. There were discussions about kind of implications on the defense industry, where innovation is playing a more critical role, how the Department of Defense might help support some of the startups that are working in their space. After that initial panic, can you kind of give us a sense of how things have played out in terms of impacting these communities?
So this is going to have a massive impact because there are 2 parts that are going to happen. One is the banking system is going to retrench for a while. So there's going to be a squeeze on credit for everybody, not only the high-tech sector, but everybody. So we will go through that squeeze. And again, we have to go through the squeeze because we grew too fast. I mean, it's like what happens to me every Christmas. I eat too much and then I have to go and exercise. The same happened to the economy. We just pushed too fast, too hard, and now we have to retrench. So this is going to be bad times. But there's a second aspect that is very important, is that small firms need to have a treasury department. You cannot manage these as if this is a small shop. Like, I'm a truck, a food truck. A food truck can be managed with a checking account and cash. Why? Because a food truck might not need too much financing. You just buy the truck with a credit, and you have a cash inflow from selling your food, and you need to spend them in the next morning to buy the inputs. It's a very simple business. You see, when you have a high-tech sector company that has, I understand, they might have only 25 people, they might have only 50 people, but they have a $200 million financing for their idea. Well, you need to invest that in someone that actually knows finance. So because you cannot manage that as assume that you deposit $20 million in a checking account and manage this as if they were cash. That's bad management. So here, by the way, this is a business opportunity for anyone that is listening. Maybe you can be like a chief financial officer for rent, because maybe they don't need a full treasury department inside, but somebody has to be managing this cash properly. So, for example, to diversify the deposits, your cash management, you open accounts in banks that actually provide the services. You don't need the $20 million to be accessible at every moment in time. You don't. So if you're a company and you have that resources, well, you have to have a plan when you will need it. And that plan needs to be provided by someone. So it was a mistake from Silicon Valley to accept the money as cash, but it's also laziness on the high-tech sector, thinking that they can manage this as if it's a food truck. It is not. So finance requires, matching needs. So you have financial needs that are short run should be financed with short run financing, and obligations that are long run should be financed by obligations that are long run. And that is true in a bank, and it's true in a company. We call this matching duration, but a treasury department, there's just no substitute to a treasury department in a company. So again, this also happened with a company that is relatively small, that grows too fast and doesn't know how to manage their success.
So I think you're addressing some of the questions that I'm seeing coming in from the audience. There seems to be some questions around how would somebody know or detect what operation management is doing from a customer viewpoint, or how might a customer better understand the operational risk or governance processes? And it sounds like outsourcing or creating treasury management functions is one way, but any other thoughts in terms of how you might be able to flag or detect these types of conditions before a significant event happens?
So on the bank side so let me separate that question. By the way, it's a very good question. So let's talk about banks first. The accounting of banks is a difficult accounting. It's very counterintuitive. So what a bank calls capital is not what we, like normal people, will call capital, and so on. So even the names and the terminology is all different. And bank accounting is complicated. And what complicates the bank accounting is how do you price things? So for example, all of us, if you buy a home, okay, and I don't know how many of the audience have a home, but if we have a home and the price of the house goes up, we don't pay taxes on that increase in capital. We don't. We are small in the grand scheme of things. So when do they realize the capital gains? When we sell the home. Is that okay? Mm-hmm. That day we pay the capital gains. We also have some taxes that are, due for local taxes and municipalities, where you have a reassessment of the home. So you pay a little bit of taxes, but truly the capital gains you pay when you sell it. See, banks cannot do that. So in banks, you have an asset. If the asset appreciates, you have a gain, and then you need to reappreciate the gain, and then you have to realize the gains. If there's a loss, you have to realize the losses. And that has implications on regulation and capital and so on. That is the job of a regulator. That should be done by a regulator. So on the banking system, my advice in general is when there are banks that are kind of, small, they should be used for small activities. That will be my advice. So a regional bank is to finance, housing purchases and regional businesses that are relatively small. So small bank for a small business, And then if you're a big business, then you need to go with a big bank. It's going to cost you more. Of course, it's going to cost you more, but it will make your relationship with the financial system more stable. Now, on the firm side, I think that there's, on the firm side, like the startups side, they tend to be very opaque. And then in general, we just know very little about it. So we know when they become public, but before that, it's a very opaque environment. So that one, you have to be kind of connected to know something. You have to, so the world of the VCs and private equity is something that, that we are exempt from any information. We don't get any information from there. So this is, I'm just highlighting that the opaqueness is real and that the opaqueness happens in both places. In the banking system, I think, is the role of the regulator. In the private sector side, there's no substitute. We just don't know. We don't know. It's unfortunate. That's why we get so many crises. Rob, this is why I write so many papers. I write the same paper 20 times. It's just like I just do a search and replace. I look at first is Mexico, then I search and replace Thailand, then Russia, then Brazil, then US. It's the same paper. It's the same mistake. It's about opaqueness and a bad regulator. So, life is easy.
So Roberto, expanding on that, I think we all remember the images just a month ago of people lining up or queuing up to get their deposits out of the bank and waiting for the doors to open. And that certainly has echoes of past crises and going back to the 1920s and the 1930s. Can you comment about kind of a regulatory pendulum? I mean, I think we saw the pendulum swing to more prudent or conservative regulations in the wake of 2008, 2009. Sorry, my lights just flickered there. But then is there a lesson to be learned in terms of tightening up on regulatory structures and then loosening and then kind of having that constant shifting of the regulatory pendulum?
What a fantastic question. What a fantastic question. So I'm going to tell you something that is very not popular. Is that clear? Like, I will never win an election by the following sentence. Okay. But regulation in a banking system has to be what is called counter-cyclical. You have to get tougher in the booms. So when things are going well, that's the moment for the regulator to become nasty. You see, like, you don't allow a single deviation. And if anything, you become tougher and tougher and tougher and tougher. Because it is in the mismanagement of the boom that then we pay on the crisis. So what you have to do is to do the opposite. Is you become a bastard in a boom, and then you're like super lenient in a recession, which, by the way, we tend to do. When we're hit with a recession or we're hit with a very bad shock, the government becomes very paternalistic, and every government becomes very paternalistic. So in 2018, we're in the midst of a massive boom. I mean, I don't know if you remember, but I would say that from 2014, 15, all the way to just COVID, the economy was doing spectacularly well. There was a huge expansion. Taxes had been cut. So that's the time to be tougher. So moving the threshold from 100 or 50 to 250, that doesn't look tougher. You see, exactly in the opposite direction.
Yeah.
So the same happened for the 2008 crisis. In the boom, starting by roughly between 1994, 1995, all the way to 2008. I know that we had a blip in our economy in 2001. We had 3 shocks that were negative, but we recovered super fast. So September 11 dot-com crisis and the Enron accounting scandals, they all happened within 6 months of each other. So we have 3 massive shocks and the economy recovered very fast. So from 1994 to 2008, you're in a massive boom. You should be tougher. And every time we had the ability going to a Republican government or a Democrat government, it doesn't matter. We became more and more and more lenient. We're addicted to success, so we want more success. And you see, in the banking system and in general in regulation, we have to be always kind of smooth in enthusiasm. So when you're too excited, I just like this game where you whack them all. Is that okay? The regulator comes, just walks several malls. You just correct the excessive enthusiasm, because you know that if something bad happened, then you will be excessively supportive. So that's kind of yeah.
Thank you for that. And shifting our perspective perhaps from the US or North America to a more global perspective, I know that there were kind of repercussions around the globe, and Credit Suisse making the headlines, and stress on other banking systems as well. Can you share your thoughts in terms of how this might have, why we necessarily didn't see immediate contagion, but to what effect did it have an impact globally?
So again, so let me separate the two questions. So yeah, this is going to have an impact internationally, and in fact, I can see this already happening in many, countries in Africa, like Ghana, Zimbabwe. They are in very bad shape right now, and I expect a couple of Latin American countries to be in very bad shape soon. And the reason is the increase in interest rates complicates the life of these countries. Also, their currencies are devaluing, which means that they have increase in interest rates and inflation at the same time, which is it's just devastating for the population. So the countries are in very bad shape, and I expect that contagion to take place through kind of the regular channels, which is what we know it happens. But then you have the contagion that is the one that is a scary one. I mean, this contagion that happens, I mean, of course it's scary for the country that is receiving the shock. So Latin America should be preparing, and South Asia should be preparing for negative news in the next couple of years. But that's not so it's bad for them. But the one that is scary is the one that is unexpected. So, and that's a contagion that happens because there are linkages that we did not measure properly. Rob, this has happened many times. So, for example, in the subprime crisis in 2008, well, when people look at the subprime crisis, they saw a market that was about $890 billion of size. So I understand it's a big size. So not surprising, the Obama administration requested $890 billion from Congress to support, because they assumed, I mean, I understand it was incorrect, but ex ante, they said, well, this is a tiny market. It's 890 billion out of 22 trillion, 23 trillion, which was the size of the banking system at the time. They said, well, it's small, it's 4%. So let me request 890. I cannot imagine I need more, because all these assets at least have some positive value. So if I buy everything, I will stop the crisis. It is on the contracts that we don't observe where this connection is the scary one, because it's in the contracts that the world is not paying attention, through which this propagation takes place. And by the way, we don't even know the size. When it hits in a very violent way, because there are massive losses, and then that is accompanied by panic. So you have the panic and the losses. There was a question here about who to blame, and I have heard many people in the financial news blaming social media for the responsibility of Silicon Valley Bank. And if you so I want to address that, because implicitly in the question, I want to make sure I can assure you that if social media starts, criticizing a solvent bank, that's not enough to produce the crisis that we observe. There has to be mismanagement, and there has to be a regulator that need not pay attention. So the trigger can be social media, reputation, and things like that. Of course, that can be a trigger. This case is a much more trivial trigger, is the interest rate. But that's only the trigger. That's not enough. You need a bank to be doing something incorrect for that to be enough to cause a financial crisis of this dimension. So I wanted to clarify that. It's implicit in the contagion question, because the contagion is not only about panic. I mean, UBS did not go bankrupt. Credit Suisse went bankrupt. I mean, they are both subject to the same panic. They are both subject to the same interest rates, but one was much better managed than the other. So you need the incompetence somewhere so it shows up.
Thank you, Roberto. Looking a little more closely at interest rates and inflation, especially here in the United States, and probably recognizing that the bank events last month probably put or made the job for the Fed that much more difficult. They're trying to navigate a different and difficult path, trying to keep us from a recession and hoping for the soft landing. What are your thoughts? I know there are so many external forces going on right now, a land war in Europe, oil production variability. What are your thoughts in terms of inflation and what that might mean to the U.S. economy going forward?
So I think that the evidence now is pointing to the inflation rate in the United States being the cause of excessive consumption in the US. So, so for a while, we blamed supply disruptions. I don't know if you remember. We were blaming supply disruptions, and we were also blaming, oil prices and gas prices, which, by the way, they are going to go up again. So, though we were blaming these external factors, but nowadays I think that almost anyone that pays attention to this inflation rate realizes that it is the US consumer. We are just consuming in excess. So that's why it has been so stubborn. And the Fed took a while to realize that. In fact, when Janet Yellen was in the central bank, she made the statement that she thought that the inflation rate was all transitory because she thought it's just the oil price going up. So don't worry. It's just gonna be self-corrected in 2 or 3 months. And I think that many people at the time thought it was transitory. But by the way, I disagree. In fact, actually, I'm on the record on my classes saying that there's no chance this is transitory. So, we are going to. So, in my classes, I remember saying many times that that this looks exactly like excessive consumption, and the reason was that the inflation rate was 6% in September of 2021, before any supply disruption and before Russia had invaded the Ukraine. So before Putin invaded the Ukraine. So those two events, the supply disruption and the invasion of Putin of Ukraine, push it further up, so almost to 10. But we were at 6 in September, so already was very high. So this is complicated because the Fed responsibility is on the inflation rate, and the inflation rate is much worse impact than the interest rate increase. And I think it's important for people to understand this. By the way, people in Congress don't understand this. Is that clear? They just don't. But the increase, the inflation rate is causing, for example, we have the largest number of delay payments on cars that we have had in our history right now in the United States. Well, that's not because the car loans are on flexible rates. That's very rare. Car loans tend to be on fixed rates. So why we have we are going to actually hit conceivably the highest, bankruptcy rates on cars, or at least we're delaying payments on cars like never ever in the history. Why? Because people have less money, same salary, and now you have to spend 10% more on food. So guess what happened? You don't pay the car. So we have a massive, massive shock affecting 230 million people. And then I have Congress saying, well, if you increase the interest rate, 2 million workers are going to lose their job. Yes, 2 million workers are going to lose their jobs. I understand it's a cost of the excessive consumption that we have. We have to retrench as the whole society. But we are doing that because, we are going to benefit 230 million workers of the United States by reducing the inflation rate. We could tax them and then protect the 2 million that are going to lose their job. But when they pose these questions like that, they're not realizing that the inflation rate is a massive tax, super unfair tax to the poor, and the Fed, their main responsibility is to make sure that we protect the poor. Now the difference here, and I understand that's why the politicians see this differently, is that the unemployment, you can see it immediately. Okay, you can see it in the street immediately. So it's just super fast signal of people applying for new jobs and new claims, like what happened today at 8:30 a.m. Eastern time. So you see the cost on the labor market immediately. The cost of inflation rate is like the warm water that kills you. You don't see it until it's incredibly late. So yesterday, came these statistics about, delay payments on the auto industry. And I said, oh my God, the Fed is going to act with an incredible sense of urgency, because the Fed understands I cannot allow 50 million people to, default on a loan because inflation rate is too high. So they are in a very bad situation, because they know that these actions have a negative implication in some sectors, and there's no like good alternative. There's not one door that is paradise. We just have hell 1, hell 2, hell 3. We just have to choose our peel, and I think the Fed is going to choose more on the lowering the inflation rate. Yeah, I come from a country that has suffered massive amount of inflation rate. We actually have the world record in 1 month, which is actually 17 million trillions percent. That's, you can think about the number, how big it is, and it's just devastating. Yes, it just produces massive amount of misery. So. By the way, this should be also a lesson for the high-tech sector. I saw a question from Camila. Is what should the high-tech sector do? Is that understand that your innovation is important, your operations are important, your finance is also important. You need to pay attention to your finance. And I understand that someone that is a good programmer doesn't know any finance. It's important that the programmer realizes, I am not good at finance, so let me hire someone that is good at finance. It's just a simple transaction. So you have the guy that invents the new vaccine together with the person that manages human resources, together with the person in finance. You need everyone to be specialized in what they do best. What you cannot do is to assume that because you have it in a checking account, that is safe. That is a mistake. So they need to actually have the whole set of disciplines to be able to do this. And by the way, if you are selling the product, you probably also need marketing. So I don't want to minimize all the disciplines.
Roberto, I see another question coming in that talks about how if the bankers can be incompetent and regulators can be incompetent, why rely on regulation to solve this issue? What's the role of the market, and what market distortions enable these collapses? And that makes me think of moral hazard. To what extent is there a moral hazard, or is moral hazard being reinforced by the actions over the past month or so?
So a great question. So by the way, the complementary question, Rob, is also very good. So let me start with what is a market inefficiency. The market inefficiency that we have is that the people that save money, so we on average are the savers, okay? We save money. We save in very short-term assets. We have something that is called hyperbolic discounting. So we save on the very short run. We want our savings to be liquid. But the financing of, let's say, commercial activity, investment, ideas, R&D, all that financing is long run. So you need someone to transform maturity, that transforms the maturity from short run deposits to long run loans. By the way, long run here is 5 or 7 on average. Okay, so it's not like 24 million years. Is that okay? No, I'm not looking at something like super long. It's just between 1 week to 1 month maturity to 5 to 7 years maturity. And the only institution that does that is a bank. So that's the inefficiency. Then there's a second aspect of this, which is because of that maturity transformation, banks will go bankrupt if depositors leave, for sure. And that's called early liquidation premium. It's an inefficiency. So I'm answering the questions from Rob. What are the inefficiencies? So the first one is that the people that want to save in short run. The people that want to borrow or need to borrow in long run. And that maturity transformation has to happen in a place in the society. And it happens in 2 places only, the government or the banks. So let's assume we are going to do this with banks, which they are better. Okay. Then the second inefficiency is liquidity, is that if you have a long a bond that is long term, if you want to sell it, you will sell it at a loss. And those two things imply that banks will go bankrupt if people leave. And this is something that we have known for many years. We gave the Nobel Prize last year. Diamond and Dybvig, the two that won the Nobel Prize last year. Well, there were three, but two of them were the ones that described this problem about this early liquidation premium. So this is we have known this for a long time, but I just want to point out that we just gave the Nobel Prize to exactly this idea. By the way, every time you give a Nobel Prize in finance, there's a bankruptcy. Okay, LTCM,
Sure.
we always have a crisis just after Nobel Prizes in finance. Okay, so this is maybe we should just stop giving Nobel Prizes to finance. But these two imply that in order to stop the run, I need to give a guarantee to the depositor, telling them don't run. And the moment you give a guarantee that is governmental guarantee, then you need some intervention. And then you are in this very delicate balance, Rob, where you need a regulator because there's a guarantee that we citizens are giving. Remember, these institutions were paying all these institutions through our taxation, through our higher interest rates or lower interest rates on deposits, etc. So we are paying for these institutions, and therefore somebody has to say, well, you have a guarantee on the deposit, but let me just offer you the regulation that limits the sources of risk or limits the use of the guarantee. So that's why you are there. So now we need the regulators and we need the banks because they produce massive amount of wealth and welfare. I mean, a person that is excluded from the banking system very likely is poor. Very likely. Cannot insure themselves against any shock, cannot finance any investment, cannot finance education, cannot finance a health tragedy. We need the banking system urgently in the world to finance all of those activities that we cannot finance ourselves. We cannot provide self-insurance all the time. It's not like I can save for myself all the time. I can save a little bit for myself, but not every citizen can do that all the time. And not all the tragedies we can do that. Imagine a hurricane. We cannot save ourselves in preparation for that. So we need that aspect implies that we need the banks to provide that welfare, but then we need to understand that we are going to make mistakes. So I don't see it that bad, Rob. So, I mean, given the question, again, financial crises happen. I said more than 150, 130 financial crises I have seen in the world. They all look identical. It's always the same mistake. It's just a matter that it happens. It's like a bad idea goes bankrupt. That happens all the time in Silicon Valley. Not the bank, but in the actual Silicon Valley.
So Roberto, for many years, people were getting next to nothing or nothing in a typical deposit, savings account, checking account. And now we're seeing a major shift in money flowing into money market funds and kind of a search for yield. A lot of the money market funds are obviously very short duration, short-term commercial paper, short-term fixed income. Any thoughts about emerging risks there as the money, it probably puts further constraints on the banking system to have it flowing from typical traditional deposit accounts into money market funds. But any thoughts of emerging risks in the money market arena as well?
So that question is hard because there are many different types of money markets. So there are some that do not offer a guarantee beyond what is offered by the banking system. So in that sense, let me explain the difference. So I'm going to explain the difference, not using money markets, but just
sure.
An example. Like when I imagine that you and I decide to put part of our savings in a Fidelity mutual fund for the S&P 500, okay, which exists. When you and I do that, what happens is that in the balance sheet of Fidelity, see, you and I bought a partition of the S&P. If the S&P goes up and down, you and I get 100% of the loss. So the capital of Fidelity is protected because this is an institution that is full pass-through. So whatever happens to the asset side in the balance sheet affects the liability side, period. So you and I get the gains and the losses. In fact, when you buy in Fidelity, they will tell you, If there's a loss, sorry, Charlie. I mean, like, go and complain to. I mean, they don't even give you an 800 number. It's like, good luck. Your investment are subject to losses. Many money markets have that flavor. They said, I'm going to invest in bonds that are very short in maturity. By the way, they tell you, so please do your homework. When you buy a money market, you can ask, what is the duration? Any money market that has more than 7 days is not a money market. I mean, they can call it a money market for regulatory purposes, but that one might have a gain and loss. So you want money markets that have very short duration, 2 days. Why? Because when the interest rates moves, the value of the asset is going to change, but a 5%, let's say, imagine that the interest rate of the Fed goes from 5 to 6%. That's a yearly interest rate. When you put that in 2 days, it's nothing. So the losses are tiny. So the money markets have a little bit of the pass-through, have very little guarantees, some of them, specifically for very large savings. And therefore, you are taking the risk that if there's a loss, you will get a loss. But when they have short duration, which is, by the way, I have all my money in anything that is 2 to 5. Is that okay? If it has more than a weekend, I don't like it. So I don't like weekends. Almost all the crises happen on a weekend. All the crises happen on Thursday night or Friday morning. All of them. So avoid having your money on Fridays. Okay. Like another theorem. So 2 days maturity. That's it. That's all that I need. 2 days maturities. The Fed never moves the rates on a Friday. They move the rates on a Wednesday. So by Friday, I know what happened. So done. 2 to 4 days. No that. Yeah.
In a sense, then it requires the same prudence as you're looking at being prudent from a treasury management standpoint of your banking relationships. Individuals should know that there are differences in their money markets, what they're investing in, their duration, things like that. So they should make the effort to be informed in terms of what the money markets portfolio comprises of, what its investment philosophy is.
Exactly. And the ones that have passed through, the ones that I described that are passed through, I know that paradoxically they look riskier, but they are not. So actually, the fact that the capital of Fidelity and the capital of Charles Schwab and Vanguard, that capital is protected, implies that the likelihood that you collect your money is close to 1. Yeah. Exactly. So you will not necessarily collect 100%. There might be some losses because you are taking some risk and it's a pass-through, but your $20 million will be actually $20 million plus minus 0.00001%. Is that okay? Because again, a 0.25% increase in the interest rate, in the yearly rate, you have to divide that by 200. So go 0.25 divided by 200, that's a tiny, tiny number.
Yeah.
That's the losses that you will get for 2 days. So you are safe. So not that big of a loss. So truly, those money markets that have that pass-through aspect, I know that they look riskier because they don't have like the guarantee that a checking account will have, but the capital of the institution that is providing you the service and the asset is protected by the way the asset is constructed. So that's why, for example, someone that does treasury in a small firm should be doing is to I have some on cash and some on a money market. And by the way, I know that I'm going to be taking the money out of the money market with certain regularity, and therefore I do the transfer. I pay for the fees, but then that's a much better financial management.
Thank you for that. We do have another question about a U.S. recession, and I don't know if you'd be comfortable in sharing your predictions or not, but any thoughts on a coming U.S. recession, and if so, how steep might that be?
Okay, so yes, we need a recession, and again, I am on the record in my classes in 2021 when I said. And let me tell you the event. I was in class teaching our MBAs. This is our executive education MBAs that are this is a part-time MBAs, and I teach at night. And on that night, what happened is that there was this news that 17% of the households that received the check during the Biden administration, you remember the $1,400 that were sent, that 17% of the families that received that check in that week, they had actually used it for betting. No, so they went to the horse race and to the casinos, buying lottery. And I remember I said, you know what? I don't care if people go and use their money in Las Vegas. That's their their decision. But I do feel that it's bad that the government is giving them money so they can actually go to Las Vegas. And I said, we're gonna pay dearly. This is a reflection that people have excessive support. They are consuming too much, and we're gonna pay with a recession. And I said that in 2021, in April 2021. So we are going to hit to a recession, and the reason why we need to hit that recession is because we need to convince consumers to consume less. And that's I want to know anyone here that in this webinar that they like to reduce their consumption by 10% voluntarily, and that's a happy moment. I mean, no one actually likes to reduce their consumption by 10%. Go to half of the restaurants that you go in a week, and let's see how happy you are. I mean, we are not happy reducing our consumption, and we're addicted to our standards of living, so we don't want to reduce them. And in that sense, what happened is that you need to create the recession to slow that consumption. And so we are going to get there. Now, how deep it is, I think that it's getting deeper and deeper. So my assessment is becoming worse and worse. And the reason is that I see this very bad news happening, and I see the slowdown on the inflation rate to be very, very slow. So I do expect the inflation rate to continue to go down, but we are still at very high inflation rate. The announcement yesterday was 5%. There was a lot of inflation on services. Still is very high inflation rate on services. That's inflation rate that tends to affect salary negotiations and so on. So it becomes permanent and stubborn, and it's very sticky. And I think that interest rates will need to continue to go up. So we might see a little slowdown on the Fed because of the consequences on the financial system, but the Fed needs to continue to go up because that inflation rate needs to come down. It truly needs. And again, the news that I just said about the defaults, you see, I'm seeing too many bad news. Delay on payments on cars. I am concerned with that. I am concerned with consumers not being able to pay their debt on the car. Are you kidding me? Repossessions are going up. I mean, bad news. Yeah. I'm sorry.
No, very sobering message, but I think our viewers certainly appreciate hearing it from you, and I think it's something that we, individually and collectively need to face. So thank you for sharing those thoughts. I know we're kind of coming towards the end of our time. I did want to touch briefly. I saw something recently about the total price tag of being $22 billion, the cost of the intervention for SVB and for Signature, and that the FDIC would be looking to much smaller. There was talk that this wouldn't be a bailout, but that the community banks or the banking system widely would need to absorb this $22 billion. And there's been a lot of pushback from the much smaller banks that serve local communities that this will be a real hit to them if they're forced to pay up for the failures at SVB and Signature. Any thoughts at the local level on how that might impact communities and people?
So I actually so I mean, this is not my numbers. These are numbers from the FDIC. So this is kind of a reputable source. The implicit losses in the banking system is 40 times larger than that. It's close to $800 billion. So it is massive. These losses, because of this mismanagement on the asset side, is not $22 billion. I understand this is the actual losses that have taken place in 3 banks, at First Republic to that. So it's true. It's true that it's 22, 25. That's how much is the actual losses. But according to the FDIC, is way bigger. Okay, so 30, 40 times bigger than that. So they are preparing for that. The difference is that now they are prepared. You see, as opposed to
Mhm.
being caught off guard, they are prepared, so they will act accordingly. This will be a discussion in Congress because it's not very clear how this support is going to come. And that is what is very important for the small banks. You see, Rob? So, what happens in Congress in the next couple of weeks is what will determine how the support will go through the smaller banks. But this is a massive hole. This is not small. Um, so, and by the way, there are many. I have found this now, so I didn't know at that time, but I have found many reports from hedge funds and asset managers and banks that they have been tracking these losses for more than a year.
Mm,
So they said that there has to be a loss, and so we have to see the loss and why the loss
yeah,
is not here. And that they are the ones that argue all the regulation is out of whack.
yeah,
So
yeah.
these losses were implicitly there for a long time. So I do think that's why we're not out of the woods just yet. Is that clear? And you can see
It
that the
is.
Fed, yeah, the Fed. I mean, we are very lucky. We have the Fed. It's just it's just a fantastic institution. It's just very pragmatic.
Hmm.
So therefore, right now they said, well, I have an inflation problem, but I have an immediate problem in the banking system. So
Yeah.
in the meantime, they are increasing rates, and they created a lending facility to facilitate this. Now, bailout. We did bail out, yes. Again, we did not bail out the stockholders. Is that okay? So
Yeah.
so the people, so those we did not bail out, but we indeed bail out all the large depositors. I mean,
Hmm.
anyone that tells you that is not, I mean, you can, if anyone wants to argue not bailout, you can argue it's not a full bailout, but it is at least a partial bailout.
Sure.
The firms did not have losses. This creates very bad incentives because these companies in Silicon Valley now they don't want to hire someone in finance. Like they
Yeah.
don't care because if they are going to be bailed out, let me just manage this in my checking account, my saving account, super non-professionally. But so but yes, there was a bailout, and this is costly for all of us, all our citizens. We have to pay, and we pay with taxes. By the way, just so everybody knows, this is taxation. Anyone that tells you that this is not costly for us, they're wrong. Uh, it, One form. Either the FDIC pays for all of this, which means that we will need to recapitalize the FDIC. So we recapitalize that through fiscal resources. So we pay taxes, and therefore somebody gets it. Or we save people through the Treasury of the United States, which means we pay taxes, so they are saved. Or the central bank saves them with loans, cheap loans, and therefore we pay in the form of inflation, which is a tax. So be ready to be taxed. Is that clear? No chance you're
Roberto,
not taxed.
with the short time we have left, I know, it's wonderful. I was last taking notes in your class from 12 years ago, learning from you, and I've learned even today. I know coming up, you're teaching in an executive education program, Understanding Global Markets, which will be taught live online May 1st through 5th, allowing people from all over the world to be in a virtual classroom with you. How have the events over the past month or so changed what you do in the classroom? You won the Teacher of the Year award in 2022. How are you going to bring this light to life in the classroom for participants in the months ahead?
So there's always a couple of days that are reserved for the current tragedies of the world. So I have been talking a lot about crypto assets and cryptocurrencies and what is the economics behind that for a while. This year I'm going to talk. I'm going to continue to talk a little bit to explain a little bit how the crypto assets work and the more current events. I have a session of the class. In fact, the one that you took, there was one about banking crisis. Well, today is going
Mhm.
to be called Silicon Valley Bank crisis. So I will
Okay.
bring more of the current data. But at the end of the day, the purpose of this is something that you learn, something that you can use 10 years from now, which I hope that you have used. Is that the principles of when a country goes bankrupt, or when a bank goes bankrupt, or what is correct fiscal policy, what is the correct monetary policy, the principles tend to be kind of the same everywhere. they're kind of, we understand them today is much better than before. Of course, there are constraints like political and social constraints that do not allow us necessarily to do the optimal policies all the time. And so I understand that we make we make mistakes, but those principles are always there. So what I try to do in the class is to have examples about, this is how we understand, for example, social unrest, and explain why that happens. And then, when this was happening in France, I was explaining the French example on why what we're seeing in the class has a mapping to what was happening in France. When then, 3 or 4 months later, it's happening in Chile. So I explained, well, the social unrest in Chile, this is how it happens. So I try to always bring the current events as a way to test or to complement the theories that we discuss. Now, when I say theories, very important. I mean, there's not a single equation. So this is MIT, but this is a very non-MIT class. It's all about the intuition. So we discuss the intuitions, but use the current events to kind of to not only bring the color and the importance of this, but also to be able to apply it. But again, in my classes, I discuss from the Great Depression to Silicon Valley and everything in between. And so, September 11, the consequences, and so on.
Yeah. And you do it in such a wonderful way, making the sometimes very complex ideas very accessible. And I just love that you encourage the engagement, the dialogue, and the interaction in your classroom, just like we have today. So I just want to thank you again for taking the time, and thank all our viewers for joining us today. I hope you found our time together as useful and as helpful as I have. Roberto, can't thank you enough, and we'll hope to see you back online here again soon.
Yes, absolutely. Well, I'm usually invited when there's a crisis, so I hope I don't see you.
We'll have to do this more often.
Yeah.
Thanks, everybody.
Thank you.